My name is Michael Guyad, publisher of the Lead Lag Report. Joining us for the hour here, Steve Schork. So, Steve, I've been tracking you for a number of years. You've been doing the media rounds for a long time, but I don't know how many people are familiar with who you are and your background. So just set the stage as far as your background and how'd you get involved in markets, in particular the oil space, and what are you doing now?
Yeah, absolutely, Mike, and welcome everybody. And I appreciate all you new Twitter users. I am a Luddite, so I always appreciate being in some good company. With regard to the Schork report, we've been publishing a daily research note on the oil and gas markets and now the power markets beginning back in 2005. And the Schork report takes a rather unique look where we look at the long-term fundamentals of a given market in this space. But as a trader and as an investor, the fundamentals are great in the long run. But specifically as you're trading, you need to be more nimble and dynamic in your decision making. So the Schork report is a combination of both the fundamentals, which give us a 30,000 foot view, shall we say, of the entire space. But we rely on quantitative modeling and technical analysis to initiate both our trading decisions and our hedging decisions. Our client base is a rather large cross breadth of the market, from anyone who's pulling a BTU out of the ground to is processing that BTU, who is selling it into a regional market. We have clients up and down the spectrum, and we provide hedging programs either for the producer who's looking obviously to sell at the highest price or the end user who's looking to buy at the lowest price. Prior to that, I was a floor trader down on the NYMEX. I was in the pits trading natural gas for a number of years, and I cut my teeth with Glencore as an analyst for 7 years, one of the largest trading houses in the world today.
Okay, and your work is primarily focused on the commodity side, not necessarily the energy equity side.
Yeah, absolutely. Keeping in mind, I came out of school in 1988. In September of 1987 is when we had that massive stock market crash. Now, I did not go to a prime business school. So coming out of school in 1988, looking to get a job on Wall Street, the typical avenues, fixed income, equities, so forth, was not forthcoming for me. So I had to take the best opportunity I had. And at the time, commodities were Wall Street's B team. So I got into the space simply because I was looking for a job. Fortunately, I was able to quickly move to a company, as I said, Glencore. It was actually called Clarendon back at that time, which was then privately held, and it was the largest trading company in the world. And so I was able to really cut my teeth on the physical side of the market. So yes, my answer to you is I focus strictly on the commodities, given that they are the best leading indicator of economic growth and henceforth the profitability of any given company.
It's funny you mentioned that commodities were part of the B team. I'd argue it was part of the B team because it was not part of the other B team, which is beta, right? Which is just right, because that's really at the core of why I think commodities have not been seen up until recently as a true asset class, because it has these periods where it does nothing for a while, price is low, and then you get these cycles that come in, and then very suddenly everyone's like, well, this is an asset to allocate to. This is an asset allocation play. So I'm sharing at the top of the space. I want to get right into this discussion around gas prices. You and I were coordinating a little bit on the DM side as far as topics, and mentioned at this point that this idea that it's Putinflation, or whatever the term that Biden throws out there, is nonsense. And I happened to put a poll out because I was curious to see what people thought. Who's most to blame for high gas prices? And the three options are Putin, Biden, and Powell. And
okay.
right now, as we're talking, the poll is still going, 3,000 votes in, 60% of people are blaming Biden for high gas prices. You've been in the business for a long time. I want you to lay out the case for why gas prices are so elevated beyond what we're hearing and maybe people's perceptions politically.
Yeah, absolutely. Well, first and foremost, I'm not going out on a political limb here in saying that this White House is the most antagonistic White House that the oil and gas industry has ever seen. And it's clearly, even beginning with the debates. And actually, in the Daily Schork report yesterday, I put forth about 2,000 words of the rhetoric and the policies initiated virtually from day one. Let's tackle a few of these. Keystone XL. Okay. So Keystone XL is not the reason why gasoline prices are high today. That's simply the fundamentals. Again, offering that 30,000 foot view just don't add up that quickly. So it is preposterous to suggest that Keystone XL, in and of itself, from a fundamental standpoint, is the reason why. The problem is Keystone XL is going to be a indicator or a driver for higher prices or prices to remain high into the future. And why is that? Aside from the additional oil that would be brought down into the Midwest and South and Southeast and in the East Coast, it sends a signal to the market and it violates the decision that one of the primary tenets of economics, and that is capital goes where it is welcomed, stays where it is well treated. And clearly, the market is signaling that it is trying to direct dollars away from fossil fuel. And the industry, of course, is responding to this. So on July 21st, for example, when gasoline prices were $3.14 retail average, this was a quote from the Secretary of Treasury, Janet Yellen. Quote, discourage new investments in fossil fuel-based power generation except where other options are not possible. We also have a number of other. August 21st, gasoline prices at $3.16, as reported by Reuters. Treasury to oppose development bank financing for most fossil fuel projects. And there's just a litany. And on a monthly basis, beginning with the primaries, before even President Biden was President Biden and he was campaigning to become President Biden, he was clearly sending a signal, and we don't have to go back to this, but he was sending a signal to the markets that investment is not welcomed. So by the 4th of July holiday in President Biden's first term, retail gasoline prices were already 20% higher. And by the end of 2020, prices were 40% higher. And in January of this year, prices were 50% higher. By the middle of February, just before Putin's tanks rolled into Ukraine, prices were 60% higher at a record $3.51. Now, since the war began, prices are up an additional 40%, recently trading at about $4.95 through the first half of this month. Yes, this rise is attributable to the war. The 60% rise prior to the war is a reconciliation of the White House's zero-sum green agenda. So the bottom line is the White House has violated, as I said, one of the primary laws of economics. Capital goes where it's welcome, stays where it is well traded. Biden and his team have made it abundantly clear that capital for the fossil fuels is not welcomed. And as a result, prices are to remain at elevated levels. So yes, it is clearly a portion that is related to Putin over the last month and a half, but the continuing rise from day one up until this past February is solely on the decisions being made by President Biden and his team.
All right, so let's talk about those decisions for a moment, because I'm with you on the rhetoric, but I don't know how many people think through what actually is being done or not done on the policy side. So what are the mistakes that are being made in terms of actual policies? How can some of those get reversed? And I have to assume that part of this is not just sort of a Biden administration issue, but you can probably trace the roots back to poor policies for decades.
Poor policies for decades, but keep in mind that we've had a dynamic shift. Barring MBA 101 jargon, we had a paradigm shift in the market over the past 20 years. So one of the biggest fallacies, and that I argued about this right when we launched the Schork report in 2005, was this nonsense of peak oil, the presumption that the world was running out of oil. The world was never running out of oil, as I argued at the time. You're looking at a period, 1980s, 1990s, when oil prices averaged below $20 a barrel. So we were not finding any new oil in those 2 decades because we were not looking for any new oil. And hence why this theory began to blow up. And it did cause a lot of interest in the market and did bring in a lot of hedge funds and banks into this space in the early 2000s. Because what happened in the early 2000s is for the first time in the fossil fuel economy, so the first time in 100 years, you had demand kicking in on all aspects. So you had the US, which was coming out of the 1990s, a very strong economy, world leader in tech, industry was humming. You had the Europeans coming out of their malaise of the 1990s, because remember, the Soviet Union collapsed in the early 1990s. So Europe had to incorporate all of that sloth from the Soviet era. And by 2000s, the Europeans had retrenched and they were coming back to the market. And of course, we had China for the first time being the super player and demand driver that they are coming to the fore. And then you also had strong demand coming out of Latin America. So we had demand coming on all cylinders. And what happened was, of course, you had 2 decades of underinvestment, not looking for new oil. So when all this demand hit, we simply didn't have the supply, nor the manpower, nor the investment to meet that demand. And prices zoomed higher, hit on a record $147 by 2008. But again, one of the other tenets of economics is high prices are the cure for high prices. And sure enough, you drive oil prices to $148 a barrel, you're going to get a lot of investment. And lo and behold, you are going to find a lot of oil, a lot of gas. For instance, we knew since the 1950s that the Bakken Shale on the Saskatchewan Plain contained more oil than the entire Arabian Peninsula. From going from Saskatchewan into Alberta and down through the Dakotas in the United States, there was more oil trapped there, again, than on the entire Arabian Peninsula. We've known about that for 60 years, but the economics never justified going in there and getting that oil out. At $148, yes, now you have the justification. So we saw a stampede into the oil patches in West Texas and in the Dakotas and in northern Alberta and Edmonton, and get this oil to out of the ground, and natural gas also. And so, whereas in the first 10 years, 2000 to 2010, we didn't have nearly enough supply to offset demand. By the end of 2010, we were just coming out of the Great Recession. So demand was already low at a time where we had this shale gale. So we had a tremendous amount of oil and natural gas hit the market, and it was a buyer's market up until recently. So we had too much supply in the market and not enough demand. Now, those dynamics are working out to this point. And in 2019, the United States, which had invested greatly, had become a dominant player in the global market. Who would have thunk that? Not me 20 years ago. But by 2019, start of COVID, so what would that be, January, February of 2020, the United States was the largest oil producer in the world at over 13.1 million barrels a day and rising. Now, of course, the market took a massive hit during 2020. And keeping in mind that any commodity market, whether you're in the wheat market, the copper market, the oil market, it's a boom bust industry. So things were booming, but the bust came during COVID, and the five largest privately held trading companies in 2020 lost $66 billion in 2020. So now we're in this bust. We're in this boom now, and that boom is now compensating the market for the massive bust it took in 2020. So now what have we learned? That the oil companies, first and foremost, have been reticent to increase or to invest in production. Again, they've already underinvested during COVID, and the signals being given out by policymakers in Washington is making them again reticent to come back in. Also, Wall Street is playing a major role in this, which I don't think gets reported adequately enough, that the bankers who finance these investments, the bankers that are still open to the idea. So we all have reports that BlackRock and other major firms are divesting themselves of investing in fossil fuels. So as that capital begins to dry up, the industry is left holding the bag. So to a great extent, they don't have the capital to invest. And they're also dealing with a massive rise in inflation for their processing costs. So the industry is now being demagogued and scapegoated for not investing or not bringing this oil to the market. Now, let's keep in mind that a year ago, almost to the day, everyone around the globe thought COVID was dead. So that would have been a signal for both Western producers and OPEC producers to start to open the tap because we knew demand was very strong. But what did we get shortly after that? We had a Greek alphabet soup of different COVID variants, of different cities, of fear of, again, economic lockdowns. We saw a number of those lockdowns in Shanghai, in China, over the past year. So once again, the market was looking at are they going to shut us down again, a la 2020? So once again, the industry was reticent. So the industry had incorporated, through that downturn in pricing when we had too much supply between 2010 and 2020, the industry retrenched. And the mistake the industry made, to go back to your point, the mistakes being made by the industry, it was the industry and their bankers. It was the industry went on to a land grab they wanted acreage. They wanted acreage in West Texas. They wanted acreage in the Dakotas. They wanted acreage in Western Pennsylvania, Eastern Ohio, Northern West Virginia. They wanted acreage to lock up all of that shale. Now, all this acreage cannot be productive. So they were sitting on a tremendous amount of debt because they went on this buying spree. When the market took a hit during COVID, of course, they took a hit. So now they're in the process of shoring up their balance sheets and consolidating. And we've seen recent bankruptcies and sales in the industry as the industry prepares for the new normal going forth. So that is kind of where the industry was, has been, and potentially going. With regard to policy enacted in Washington, we don't really have any policy. We've had 3 releases of oil from the Strategic Petroleum Reserve, which was just I said it, I think, on our DM earlier, Michael. Some of these decisions just want to make me retch because releasing barrels from the Strategic Petroleum Reserve cannot lower oil prices, cannot lower gasoline prices. That's not the design of the Strategic Petroleum Reserve. The Strategic Petroleum Reserve was created during the Ford administration in response to the Arab oil embargo, and barrels started moving in during the Carter administration. And the whole point of the SPR was to put oil on the market when there was a short-term disruption to the flow of oil. So a hurricane comes in and knocks out a lot of production in the Gulf of Mexico. Boom, you release barrels from the Strategic Petroleum Reserve to get as a stopgap. Or the Libyan civil war that we saw during the Obama administration takes a lot of oil off the market. Obama made the correct decision and released barrels from the SPR to account for this stopgap. And before this administration, with the exception of the Clinton administration towards the end of his administration, but virtually every single administration prior to this has only ever used the SPR for what it was designed for, and it worked beautifully. It was able as a stopgap to offset this short-term disruption. Releasing barrels today, which amounted to just a couple of weeks, not even, of U.S. demand for crude oil, what was an absolute gimmick, and no way was it ever going to release. So that was another gimmick, a short-term fix. Some of the other short-term fixes we've had, and I think one of the most egregious ones, and one that are going to lead to massive inflation at the grocery checkout counter in the fall, is the move to artificially increase demand for corn. Now, the ethanol industry already consumes 40% of U.S. corn production. Now, with the waiver to up production or up the quantity of ethanol and gasoline blends from 10% to 15%, you're just going to create more demand for corn, for ethanol, obviously. Now, the problem here is that our war over the last couple of years on natural gas has decimated the fertilizer market. Natural gas is the primary feedstock that goes into ammonia nitrate, which is fertilizer. So fertilizer prices have spiked because of natural gasoline prices have spiked. So what has happened, natural gas prices, I said. So what has happened now is farmers are being discouraged to plant corn this spring because corn requires a tremendous amount of fertilizer. And they're in its place, they're planting soybeans because soybeans are require less fertilizer. So now we're in a situation where we've increased demand this summer for gasoline, corn-based ethanol, and at a time when our crop yield of corn in the fall is going to be lower. So that could only lead to higher prices going forth. So that is probably the most dangerous. We have a couple of other gimmicks, gas cards or tax holidays. Of course, if they're not going to work, and unbelievably, Gavin Newsom, governor of California, is coming out with, I believe it's a $19 billion fund that is going to give people in California who qualify based on their income $1,000 in their pocket. Now, that just violates the Econ 101 textbook definition of inflation. You don't have enough supplies in California already, and now you're increasing demand further by handing people another $1,000. So we're just on this perpetual cycle of the remedies we're trying to come up with, the policies that are being initiated are just fueling inflation. If the White House really wanted to address the issue, the easiest thing they can do, and I don't know why they're not doing it. The clients, and again, I have some very big clients who I know are telling the Department of Energy just this, is to rescind the Jones Act. Now, the Jones Act is a piece of maritime law that was enacted, I don't know, maybe 100 years ago. The sole intent of the Jones Act is to protect the U.S. merchant marine industry. So what the Jones Act requires is if you have interstate commerce, waterborne commerce being put on a ship or a barge that you're going to go from one U.S. port to another U.S. port, that commodity or that good has to be transported on an American flagged vessel. Now, the problem there is we don't have enough American flagged vessels. So we have a low supply of vessels to move gasoline from the Gulf Coast over to the East Coast. And because we have a low supply of vessels, the charter rates, the rates to hire these vessels are very high. So what is actually happening now is we are producing, and just over the past 2 weeks, we produced in excess of 10 million barrels a day of gasoline, which is a very stout number of production. So we are producing gasoline, but we're unable to get it to the market area. So this incremental demand, this incremental supply of gasoline that we are producing is actually being loaded on foreign flagged vessels. And guess what? It's going to Mexico. It's going to South America because we cannot move that gasoline on those foreign flagged vessels and take it into New York Harbor, which is the take point of the NYMEX gasoline and diesel fuel markets. And this is the easiest thing because what has happened since 2008? Because the big question is, why are gasoline prices so much higher today when crude oil prices today were lower than they were in 2008? And the answer is we don't put crude oil in our cars. We don't put crude oil in our homes to heat our homes. We put gasoline there. We put diesel fuel there. And we've had the refinery market capacity in this industry has been decimated over the past 10 years. So we simply don't have the capacity to turn crude oil into what we need. So that is especially acute on the U.S. East Coast. Here in my hometown of Philadelphia, we used to produce just 3 years ago enough gasoline on every single day to fill up 250,000 cars. 250,000 cars of gasoline were produced in Philadelphia every single day. That refinery that produced that gasoline is no longer there. It is a brownfield. So that is a tremendous amount of supply that has gone missing. So Philadelphia, Baltimore, New York, the Northeast are relying more and more on production coming out of the Gulf of Mexico. Now, there's only one major pipeline, the Colonial Pipeline, that takes that product into this market area. And that pipeline is at full capacity, as you could imagine. So your only other option is they put it on ships and get get it into the East Coast. But we can't do that because we don't have enough American flagged vessels. So your only other option is to go over to Amsterdam, Antwerp, Rotterdam, which is the Houston, the refinery epicenter of Europe, and buy your product there and ship it 3,000 miles across the Atlantic. And as you can imagine, that costs a lot in your transportation costs. So just by this one act, rescinding the Jones Act would be a tremendous relief on the market. It would get supply from where it is being produced to where it is being consumed, and it would be a massive driver in bringing oil prices lower. Why the administration is not doing this, it is an absolute mystery. But this is a slam dunk for the administration if they would listen to the industry.
This bit about the Jones Act to me is really a bit of a revelation. I had not known about it myself, but because we keep hearing the U.S. is energy independent, the U.S. is energy independent, and it seems from what you're saying that it's not about the independence. We have the supply. We just don't have a reduction of barriers to actually get it to us, even though it's here.
Yeah, absolutely. Now, yes, there is this idea of U.S. energy independence, and up until a couple of years ago, we were independent. Now, that doesn't mean that we built a wall around the United States and we're producing all the oil we need. We were independent from the standpoint that oil is a globally traded market. So crude oil, depending on the geology, depending on the type of ground you're and the type of flora and fauna that was turned into crude oil 10 million years ago, no two crude oils are the same. So they have different viscosities, they have different weights, they have different sulfur requirements. You have quote unquote clean crude oil, you have dirty crude oil. So from an independence point, the US was independent. Now that doesn't mean we were never going to stop importing crude oil into the United States. We would never want to do that. Why? Because the production that is the U.S. is strongest out. We produce a very fine, a very light, a very clean, put quotes around clean type of crude oil, which is very easy to refine. So it requires less processing at the refinery to turn turn that crude oil into what really makes money for the refinery, and that is gasoline. Second would be diesel fuel. So the United States has an abundance in its production of this type of crude oil. Now, the good thing here is the United States is also home because we've invested billions over the past 20 years into our refineries to process very heavy, dirty crude oil, which requires a lot more processing. And because it requires a lot more processing, this heavy crude oil is very cheap relative to the crude oil that the United States primarily produces. So our refineries are the most sophisticated refineries in the world and are capable of producing this very hard to refine crude oil. So what we do here in the United States is we are exporting our high value crude oil because we can't necessarily use it, and we're swapping it out for heavy crude oil that's being produced elsewhere around the globe. So essentially, the United States is exporting caviar and we're importing tuna fish. So it is a win-win, both from the oil and gas industry, but more importantly for the consumer, because this makes the economics to get crude oil into your gasoline tank. So it is a very favorable situation. Now, unfortunately, over the past couple of years, we took the hit during COVID. And as I explained before, the industry is reticent for a number of reasons to bring this production back. So we're sitting on, as I said, 2 years ago, the United States, just before COVID, the United States was the largest crude oil producer in the world at well over 13 million barrels a day. We're still about at 1 million barrels a day below that, where the EIA updates every month. So we're right around about 11.9, 12 million barrels a day. And we're kind of holding there. So we simply aren't producing. And unfortunately, we're talking to OPEC. We're talking to Saudi Arabia. Saudi Arabia, which on the campaign trail, the president of the United States called a pariah state. We're now asking Saudi Arabia to increase their production. So the president is going to go over to Riyadh to talk to MBS to ask them to produce production, but he has yet taken a trip to Houston to talk to the industry there. So I've quipped numerous times in the media and in the Daily Schork report, this administration would rather talk to terrorists than Texans when it comes to increasing production around the globe.
Everybody's here. Make sure you follow, by the way, Stephen Schork, and check out his research. You'll see the website on his Twitter profile. I think this is a fascinating discussion. I've had a lot of energy experts on these spaces in the past, but I think the way that you're framing things and the detail around it is really interesting. Now, I want to get into the fundamentals for a moment here.
Yes.
Because everything's about supply and demand, right?
Yes.
And again, you've done this for a long time. You have these quant models that help you determine sort of, where prices are likely to go. Talk about some of the inputs that you look at that maybe the media does not focus on, that are important to have a real understanding of the trend of oil, the trend of natural gas in general.
Yeah, absolutely. And the first and foremost with any commodity market, it's seasonality. So, and you look at the structure of the forward curve, otherwise known as the term structure. And the term structure, the spreads, the difference in pricing between oil delivered in the month of September, for instance, and the price delivered in the month of October. Is September at a premium to October? That's a backwardation. Is September at a discount to October? That's a contango. And the spreads can tell you a whole lot about the underlying fundamentals of any given market. Now, for instance, we had a situation, as you may recall, in the natural gas markets back in 2006. A $9 billion hedge fund called Amaranth was a major player in the natural gas market. Now, they put on spreads where they were buying the front month contracts, and this is just an example. I don't know if this was exactly their trade, but this was an example of the type of trading they were doing and how they blew up. But they were buying the front month contract, the October contract, all through the summer. So they were buying natural gas for the delivery in the month of October, and that contract was trading at a discount to the contract for delivery in the month of November. Now, natural gas is a major heating fuel for the winter. So the fact that the November contract was trading at a premium makes a lot of sense. But what happened is, and what happens is that margin, typically will tighten. Now, Amaranth went ahead and they did the opposite of what historically that spread always trades on. And why did they do this? They did this because the year before they had the exact same trade on. They were long the October, short the November, and that trade blew out. October's price to November blew out. That has never happened before. Historically, the November contract always collapses relative to November, but it didn't happen in 2005 for a very obvious reason. 2005 was until last year, was the most active Atlantic Basin hurricane season we've ever seen. So we had a significant amount of production knocked out. And of course, it was capped with Hurricane Katrina in late August and then Hurricane Rita in late September. And because at that time, 20% of U.S. gas consumption was produced in the shallow water Gulf of Mexico. When Katrina and Rita and a number of other hurricanes came in earlier, they sidelined a lot of that production, and the spot prices, the August, September, October contracts blew out relative to the later dated contracts. And that was only because of one rare fundamental event. Now, Amaranth made reportedly $1 billion on that trade. They tried doing it again in 2006, and it absolutely blew up in their face, where once again, they were betting on another busy hurricane season, and it never happened. We did not have one hurricane in 2006 that made landfall in the United States. And so what happened, Amaranth was long the part of the market. They were short the back part of the market. And when we didn't see any disruption to production, then the market collapsed and Amaranth lost $6 billion of other people's money and the fund collapsed. So what the media doesn't kind of focus on is the structure of the term. What we want to keep in mind is in a healthy market, in a demand-driven market, the commodity market should always be in backwardation, meaning that the price for this month should be at a premium to the price the month following, because this is a sign that the market is inducing you to take supply out of your storage and meet it and sell it at this higher price in the spot market. And that is a very good market indicator of a fundamentally strong or fundamentally driven market. And this is essentially what we've had now both in the natural gas, where we had a massive blowout until recently, massive blowout on the front end of the curve because we're looking at next winter and the market doesn't have, its fear is that the market doesn't have enough natural gas for next winter. So we have to buy a lot of natural gas today to put into storage to get ready for next winter. And because we have the situation in Europe, they also have to buy a lot of natural gas today and get ready for their winter. But obviously, they're under a greater bit of pressure because of the situation in Ukraine. So we're looking at, and first and foremost, I'm always looking at the spreads to tell me the underlying fundamentals. Because once again, markets aren't perfect. That is to say that they are efficient, but they're not perfect. Information gets leaked out into the market. So the price at any given time is not necessarily reflective of the underlying fundamentals. The fundamentals don't move that fast, but you get a good telltale, a good leading indicator of where the fundamentals are hiding based on the structure of the forward curve, the term structure. And is that backwardation growing? Is that backwardation narrowing? Is that contango? So forth. And that's giving you indication of where supply and demand is and where the market expects supply and demand. And the media really doesn't, honestly, look, the media only focuses on one thing: gasoline prices. They only focus on that because here in the United States, you cannot drive in any town, in any city, you cannot drive more than 2 blocks down Main Street and be constantly reminded of the price of gasoline because we have so many gasoline stations. So that's primarily where the industry is focused on. It's just the price, but the media, excuse me, but the media doesn't focus on, for instance, when that in the Philadelphia refinery, which was heartbreaking for me being in this industry, when that refinery closed 3 years ago, nobody in my part of the county, in Delaware County, could care less. That refinery was in the southern part on the Delaware River, and you go to cocktail parties, you talk to lawyers, you talk to lawyers, you talk to mainly lawyers and a lot of doctors, and they could care less what is happening on the other side of the county. They care now because that gasoline making machine that was there 3 years ago, it was no longer there. But you don't focus on the here and the now. You just focus on 3 years ago, gasoline prices were cheap. They got even cheaper during COVID, but now they're really expensive. And now the media is beginning to wake up and say, wait a minute, we don't have enough refineries here. That's a problem. And it's a problem that's going to continue to bite this economy in the rear for the foreseeable future.
It's interesting to me, Stephen, that I didn't hear you talk about the Fed as part of the fundamentals and interest rate policy. How much does monetary policy impact underlying fundamentals for oil?
Yeah, it's a great question. The dollar, U.S. greenback, is still primarily, it's losing its hammerlock on the market, but global commodities are still primarily priced in dollars. So there is an inverse relationship between the price of commodities and the price of dollars, because as we're seeing now, we have a very strong dollar, as strong as it's been in decades. And so what this means is it makes oil, if you're buying oil now in a non-dollar denominated, the yen, the euro, so forth, that price of your commodity is much stronger because you have to convert into the more expensive dollars. So it retards a strong dollar retards global demand for commodities based on the fact that they become more expensive. So the monetary policy with regard to the Fed and the Fed and Powell absolutely just mind-blowingly could not see inflation coming, and they hung on to this absolute idiotic fallacy that inflation, which was being driven by the commodity markets, my area of expertise. So we knew here, and our clients knew, that inflation was only going to get worse. How Powell missed this is an absolute mystery. And it can continue to get more dollars onto the market, which continues to fuel inflation. Powell's hands are now tied. And honestly, I don't see how he can rectify the current situation without doing a Paul Volcker in the early 1980s and killing the economy with interest rate hikes to create this demand destruction. So Powell is absolutely part of the equation with regard to monetary policy. And the fact that we do have a strong dollar is a detriment to demand growth elsewhere around the globe, and certainly sows the seeds for another potential risk of inflation in the foreseeable, recession in the foreseeable future.
Let's talk about tail risk for a moment, because commodities, I think, have been shown historically in general to have upside tail risk, meaning that you have a supply disruption and suddenly prices go up, whereas equities would have more downside tail risk, which is what people would associate with a stock market crash. Is there, other than some kind of insane interest rate hike that immediately causes a recession like the day after, is there any sort of potential for a negative tail risk event when it comes to oil that could cause oil prices to really collapse? I know we can argue that, maybe if there's an about face or a ceasefire with Russia Ukraine, that might, at least for a moment in time, cause a severe breakdown. But is there anything that you think could really break things quickly?
Yeah, it's a great question. And to your point, in general, yes, the tail risk in commodities is higher. But there is a significant amount of downside tail risks. And I'll give a recent example. It was news to people back in April 2020 that commodity prices, oil prices, could go negative. And they did go negative, as we all know. But negative commodity prices they're not common, but they're not as rare as you might think. We've seen a number of negative pricing, especially in the natural gas market over the last 10 years. And why is this? Well, in the NYMEX, the New York Mercantile Exchange, its crude oil futures contract, its delivery hub is in central Oklahoma, Cushing, Oklahoma. Now, what was happening is at the start of COVID, crude oil prices collapsed from about $50 a barrel, and they got back down into the until around $20 a barrel. Now, you had a number of speculators, retail investors that came in buying up a lot of $20 oil, thinking they're buying $20 oil and that prices were just going to rocket higher because $20 oil was so cheap relative to the past 20 years. Now, the problem is that this is a futures contract. So if you own a futures contract, before that contract's month expires, you must sell that contract to flatten out your position. And if you buy the contract and then eventually sell the contract, then you don't have any obligation in the physical market, and your P&L is based on the price you bought it at and the price you eventually sold it at. The problem with the retail investor, what they didn't realize was that the supply hub in Cushing was already full, or its obligations were already full. So what happened is when the contract for May came to expiration in the month of April, all these people that were long these contracts, now they had to sell these contracts to flatten out their position. The problem was the physical traders, the bigger traders, knew that the physical market, the tankage, the storage was already full. So no one was going to buy back these contracts because there was no place to put this oil. Because if you go off the board, if you expire and you bought one contract of 1,000 barrels of oil, guess what? You're going to get a phone call that night from the New York Mercantile Exchange and said, "Hey, where can we deliver your 1,000 barrels?" And it has to be in Cushing, Oklahoma. When there's no space, what happens? These real traders had to start lowering the price to finally induce someone to come and buy. And they did it to the point where they drove oil prices on that expiration to minus $40 a barrel to finally get enough buyers in the market to take them off the hook. And of course, they took a massive hit. So you do have this tail risk based on the fundamentals. So again, knowing where the fundamentals are for everyone listening, know where the story, when it comes to the future, know the position or the disposition of supply. So with crude oil is you want to know what the supply situation in Cushing is. And from that standpoint, there is no tail risk at this point because Cushing supplies are at near historic lows. So there's plenty of storage space in Cushing. The same goes with the storage space in New York Harbor, where that's the delivery point for the New York Mercantile Exchange's gasoline and its low sulfur diesel contract. So you want to know the situation of the storage in there to ascertain is there low tail risk with regard to commodities. So from that standpoint, to your point, Michael, with regard to what it would take, yes, I do think that hopefully we'll see some sort of peaceful resolution in the Ukraine based on our modeling. And this was before Ukraine, our yearly model, which we calibrated back at the end of December, beginning of January. So about 6 weeks prior, about 7 weeks prior to the invasion, we had the upper lower quartiles for crude oil in between $100 and $125 a barrel. And that, based on our modeling, was the range that we expected this to occur in. And that's essentially through the first half of this year. That is where we've been trading. We got up about 2 or 3 weeks ago. We got up to $130 a barrel. That told me the market, we had no real fundamental news in the market. And that told me, okay, the market seems a bit overpriced there. Then we did get a collapse and the market traded down to about $101 last week. Once again, yes, we're having some recession fears. I'm certainly prominent in the media talking about recession. And you had some of that fear take hold in the market early last week. Prices got down to about $101. But we've popped right again, and we're back up to around $110, $111 a barrel. So that is the parameter. That's the range I'm working in. So the quantitative analysis, you come up with your ranges, and when the market breaks above or below, then that's your telltale that something fundamentally has changed in the market. So based on that, would a resolution in the Ukraine situation drive oil prices lower? I think temporarily so. There is that risk, but I don't see the risk much below $100 a barrel because keeping in mind, I modeled this market before Ukraine. So I would certainly expect a retracement to 100. And I think you could see a short-term trend back below $100, but I don't think it would be lasting. The real tail risk, again, is a significant disruption in the flow of oil. Right now, we have civil unrest in Ecuador, which is a major oil supplier to refineries on the west coast of the United States. We have social unrest issues in Libya, which again is a big dominant supplier to the East Coast and also the West Coast. So there's rumblings that oil production in these two important countries will be disrupted if the civil unrest continues. And that sent kind of a shockwave through the market yesterday. So all it will take to get us higher, should we say, is we're one headline away from a major upside tail risk. For the downside, you'd really have to see a significant amount of supply come into the market, and that's not happening. Production is not going to meet it. Domestic production is not going to meet it. Foreign production is not going to meet it. So you're not going to see the answer coming in on the supply side. You're only going to see it coming in on the demand side. And that demand side would be a significant destruction in demand, which I think only can come vis-a-vis recession. So what is our modeling telling us there? Well, in that worst case scenario, we smash through $100 a barrel. And our first stopping point, we don't get to until we get down to $70 a barrel. And then if this recession is on the scope of the Great Recession, then we're looking at oil back below $50 a barrel. But that's not a good thing. Keeping in mind that is we want strong commodity markets because strong commodity markets are strong because economic growth, economic demand is keeping demand for commodities strong. So solid, firm pricing for commodities is a good telltale. Oil prices, if 6 months from now, if oil prices are $70 or $50, that's a problem because we are going to be certainly in a severe recession at that point. So from my standpoint, the only downside tail risk, Michael, right now is the significant contraction in the economy over the next 6 to 12 months.
Yeah, it's interesting because there's really only two kinds of money when it goes into when you talk about the commodity space, right? Futures, contracts, hedgers or speculators. And it doesn't sound to me like you think there's a large degree of speculation in the space. Because I've had some people argue that you can bring prices lower if you simply lower margin or increase margin requirements, right? With some of these speculators trying to play the oil futures contract side. But from everything I'm hearing from you, it sounds much more that that's not the case.
Well, there is speculation, but it's more this is fundamentally driven the price rise because we have a long term imbalance between supply and demand, and certainly when you see this imbalance, you're going to invite speculation and you're going to drive prices higher, and this is a good thing in the long run because high prices, like we saw in the early 2000s, high prices are the cure for high prices. So this does send a signal to the market to get more supply to the market, and that will ultimately drive prices down. Now, speculation beginning 20 years ago is an easy target, and people do take aim at speculation. But keep in mind, you need speculation because we will not have a functional, fundamental commodity market around the globe if you did not have speculators taking a place. Because what the speculator allows, it allows the producer someone to sell a producer to sell their risk off. If you're producing corn at, and I'm just picking numbers, or let's steep in oil. If you're producing oil in the Permian and your certain play, you could make money upwards of $40 a barrel. And you've got someone who's willing to buy that oil from you down on the futures curve at $50, $60 a barrel. You're going to continue to produce oil to meet that higher price that speculator is willing to buy from you. So the speculator is the liquidity needed, especially now because the banks some of the larger banks are being ushered to the side when it comes to investing in fossil fuel. The investor is providing the capital. They're supplying that grease to the engine that allows the producer, whether it's a corn producer, a aluminum smelter, so forth, it allows the commodity producer an avenue to de-risk their portfolio, and it gives them an avenue to continue to produce. And the speculator is a long-term tool that allows a commodity supply, any commodity, to continue to be brought to the market because it lowers the risk for the producer.
Yeah, no, I think that's a very valid point. Maybe for the last few minutes here, Steve, I want to hear your thoughts on how ESG, green, alternative energy kind of plays into these longer term fundamentals, because a lot of people make the case that we're in this mess because there was such a focus on ESG. The pendulum swung so far to that side, and kind of similar to what you were talking about earlier, it caused this divestment, this sort of aversion to in putting capital to work in oil and gas and energy. But there is another interesting part of this, I think, which is that the longer the average price of oil stays high, the more there might be be a doubling down on alternative energy, because now on a comparative basis, maybe it does look more attractive, which might actually make it even worse in terms of the fundamentals longer term for oil. Talk about the interaction with alternatives and the ESG movement, and if maybe there are some other unintended consequences that might be happening if oil stays on average elevated.
Yeah, absolutely. And it's a great point. And, keep in mind, prior to the last, I wouldn't even say 10 years, but let's going back to the last 5 years, the demand for gasoline was the most inelastic of any commodity in any given market. Regardless of the price swing, you still had to drive, you still had to get your kids to school, you still had to get to work, you still had to transport goods across the country, you still had to fly. So energy costs, and specifically gasoline, you did not get a commensurate decrease in demand as prices rose. So the two fundamentals, or the two variables that drive a market price, are price shocks. Now, going back to the early 1970s, we've seen a number of shocks, starting with the Arab oil embargo, and then in the early 80s, the Iran-Iraq war, early 90s, the Iraq invasion of Kuwait, so forth. So we've always gotten those price spikes, and we've always had a crash. So we've always had those booms, and those booms have always been followed by busts. And that, essentially evened out the price over the long term. The one thing we did not have until recently is the second variable you need to impact price, and that is the substitute. There was never a substitute for gasoline. Now, of course, with EVs, with hybrids, and so forth, we now have that substitute. So that certainly is making an impact. And ESG and investment in alternatives is good where it works. Solar works really well in Southern California. It doesn't work well in Central and Northern California. This is why you have wind. Wind in California works really well until you get to the month of November and the Santa Anas begin blowing, and the wind blows too fast for the windmills to handle, and the windmills have to shut down. The same with hydro. Hydro is very important for the economies and the markets in the west coast of the United States. Hydro is responsible for 10% of California's power generation. We have a major drought in California. So that is a problem. So when we continue to put all of our eggs into a resource that is 100% reliant on Mother Nature, you're not going to have a stable market. So that's one of the drawbacks. Now, I want to be clear. I am pro green energy. I am just not pro green zero sum energy policy, which is what we have. We have a policy that's being enacted that is binary. If I have to close down a coal plant, I have to build a solar panel. That means I have to close down a coal plant. You have to be able to coexist and allow the market to grow organically. And eventually we will get there. But we're in a hurry to trip over ourselves to move towards this green energy agenda. And keeping in mind, green energy is not green as far as electric power, electric motors are concerned. When you think about the amount of earth that is going to have to be dug up to get access to the rare earth metals, and of course, none of that's going to happen in the NIMBY crowd here in the United States. So just what we're seeing in Europe, we're going to become more reliant on China and their policies, and in Africa, which China is investing heavily in. And we can see what happens in Europe when you sell off your energy security to a tyrant. Eventually, you're going to have to pay up. Now, the amount of earth that is going to have to be scraped away to get access to these minerals will make 100 years of coal mining and crude oil exploration seem like nothing. So it is not the environmentally friendly when it comes to the mining of these minerals. So it is this, we're under this guise that, yes, look, I have a hybrid. I get, blended between the electric motor and my gasoline motor. I get 75 miles to the gallon. I love the darn thing, but I'm not fooling myself for an instant that I'm doing something that's bettering the earth. I know that the rare earth metals that are ripping the earth apart, the disposal of windmill blades right now, because we're into the new generation, they're just rotting in fields right now with no absolute use. So the amount of degradation we're doing to the environment to get to electric is in some instances no better off than if we just stuck with a pure natural gas. I mean, get rid of coal, I get that, but you need a replacement. And your only viable replacements are natural gas and nuclear. And go try to build a nuclear plant in the United States nowadays. That's not happening. So your only avenue is natural gas. But we've got this binary zero-sum green agenda, and we're underinvesting in natural gas, which is the shores. Prices are going to be high for the foreseeable future. And I'm talking years, not months.
Yeah, I think that's a great way to end this space. Everybody here that's here again, please make sure that you follow Stephen Schork on Twitter and check out his research. His website's on his Twitter profile. This was really very educational. I got a lot of comments from people saying this was just unreal this hour here. Steve, first time you and I are talking. Really do appreciate you spending the hour here. So thank everybody for joining. Thank you, Steve. Appreciate it.
Thank you, Michael. And thank you, everyone. Have a good day.